Despite the current stock market boom, which doesn't seem to be losing a whole lot of momentum, it's been a struggle to find revenue growth among the S&P 500 companies that have reported Q3 earnings so far. Chief equity strategist and economist John Blank is here to elaborate. John, why do you think that is?
Terry, I think it's a simple fact of global growth being not strong enough. And it's the global growth that matters, Terry, not U.S. growth for multinationals, because you mix basically 40% international into the most mixed and stronger amounts up to 60% for Infotech. So you own a lot of companies that have a lot of revenues coming in from abroad. They're not doing that well, and that's what we're seeing.
So is what you're saying, just to clarify, one reason we're doing so well in our market is because the rest of the global markets aren't?
Yeah, strangely enough, that's true, because the global markets aren't doing well, and that's spooking the Fed, and that Fed is then getting involved in both restarting quantitative easing and cutting interest rates. So we're seeing it's the usual bad news that's good news, because the Fed has liquefied, particularly the short end of the curve, and this is putting a lot of short-term hot money pushing the market up.
Well, stock valuations are real high right now. Have you seen anything in this earnings reporting season, though, that justifies these high valuations?
Yeah, in a nutshell, no. The answer is no. I have not seen anything that justifies these valuations, and that is the extremely important thing to note. However, that's not a bullish statement, because we still have the Fed backstopping the liquidity of the market, and markets are financial markets. They don't have to follow the economy. They often don't. So that's not actually as scary as you might think, but the truth is there is absolutely no indication. The latest leading economic indicators were another month of negative reports. So it's just not looking that good. It's not looking terrible, but it's not looking good.
So as we speak, the retailers are reporting their Q3 earnings. What do you think that those earnings are going to say about the holiday shopping season and the consumer in general?
They are going to say the same thing. I think we've seen it's going to be strong, but not as strong. And I think we're going to start to see some of the manufacturing dominant areas of the country see some pullbacks and some worry. And I don't think anybody in most of the urban areas is going to notice anything at all. I think you got to remember that shopping, a lot of people shop out of habit, and they shop better for better prices and better selection they can find online, and they shop socially. So this type of year, as long as the weather holds up for us, we're going to do fine.
So with the Fed lowering interest rates, is the real concern now inflation?
No, there's no concern about inflation out there. I wouldn't say no concern, but, with the manufacturing recession pushing down on wage growth in the United States, and the Fed pushing back with lower interest rates, it's kind of a push-me-pull-you situation. We're likely to go sideways, not up or down on inflation.
Well, we're talking here in November. Last month, the Federal Reserve began buying up short-term Treasury debt to the tune of $60 billion per month. Is this just more quantitative easing?
It is, Terry, but we got to understand that it's got a lot of caveats this time around. First of all, there's a fully valued, no excess macroeconomy. Number two, a lot of this is being driven by some type of yield curve inversion or arbitrage across bond securities by the big banks, and the Fed is supplying that demand for the arbitrage. But the reason I say that is this QE is driven by arbitrage. Arbitrage typically disappears and can reverse. So the problem here is if that's the trigger, and I don't think anybody will really fully know who's not playing the arbitrage game or talking to the Fed directly or being part of the Fed. But the point is there's QE until that demand dries up, and it could. And that's the problem here is it's not just full stop, leave the faucet on QE. It's QE for a reason.
All right, so bottom line, will the stock market rally, even though it's taken a little bit of a pause here, will the rally continue strong through the end of the year, or is this uncertainty over the trade situation going to derail it?
Yeah, let's stay tuned on that. The jury's out, Gary. It's a mixed message, and I don't think anybody should be either bearish or bullish. You should be both bearish and bullish. That sounds stupid, but when stocks are real high like they've been, move to cash with your big winners, but also play stocks on, because the tech stocks, the cyclicals, are still doing well, and that seems to be the case. The market's betting now that the recession's a year further out than they thought last year.
All right. Well, speaking of stocks on your radar now include Garmin, Martin Marietta, and SK Telecom.
Yeah, let's start off with Garmin, ticker GRM. Man, this is Zach's number one ranked stock, the GPS maker. Here's a classic example. Value score of D, right? Value score of D, forward P of 23. That's really high. So great stock. I mean, great company, but not a great stock. And this is going to probably pull back as time goes on. But you want to keep it on your radar when it does. Martin Marietta. This stock is, it's in a material supply space. Again, ticker, the value score is D. But what it does is it provides construction aggregates, mainly cement. So if you like the new housing figures out today, you like Martin Marietta. Third one is SK Telecom. This is basically a South Korean defensive stock. The value score is B. So it's a much better stock. The problem here is nobody's buying international stocks. There's no bid on this stuff. But keep an eye out for stuff like this. And at some point, people will shift into it. I don't think that point is here now, but I just want to throw that on people's radars that SKM is, if you're looking for a defensive stock that's in the international space, that's one to look at.
All right, Chief Equity Strategist and Economist John Blank musing with me on the global markets. And with John, I'm Terry Ruffalo, and before we leave you, here's a reminder for our listeners. For a limited time, you're invited to follow market insights, buys and sells from all of our recommendation portfolios at Zacks, and you can do that in real time. The best part is it's only going to cost you $1, but it's only for a limited time. And you can even look into services that are so exclusive up to now they've been closed to new investors. To do that, just visit Zacks.com/promo. You'll get all the details there.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.